sector has been.
Fed Chair Jerome Powell is speaking after the Federal Reserve cut interest rates by a quarter of a point.
The strong performance of the U.S. economy over the past year. In our summary of economic projections, committee participants generally expect GDP growth to remain solid, with a median projection of about 2% over the next few years. In the labor market, conditions remain solid. Payroll job gains have slowed from earlier in the year, averaging 173,000 per month over the past 3 months. The unemployment rate is higher than it was a year ago, but at 4.2% in November, it has remained low. Nominal wage growth has eased over the past year, and the jobs-to-workers gap has narrowed. Overall, a broad set of indicators suggests that conditions in the labor market are now less tight than in 2019. The labor market is not a source of significant inflationary pressures. The median projection for the unemployment rate in the SEP is 4.2% at the end of this year and 4.3% over the next few years. Inflation has eased significantly over the past 2 years, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.5% over the 12 months ending in November, and that, excluding the volatile food and energy categories, core PCE prices rose 2.8%. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The median projection in the SEP for total PCE inflation is 2.4% this year and 2.5% next year, somewhat higher than projected in September. Thereafter, the median projection falls to our 2% objective. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. We see the risks to achieving our employment and inflation goals as being roughly in balance, and we are attentive to the risks on both sides of our mandate. At today's meeting, the committee decided to lower the target range for the federal funds rate by a quarter percentage point to 4.25% to 4.5%. We've been moving policy toward a more neutral setting in order to maintain the strength of the economy and the labor market while enabling further progress on inflation. With today's action, we have lowered our policy rate by a full percentage point from its peak, and our policy stance is now significantly less restrictive. We can therefore be more cautious as we consider further adjustments to our policy rate. We know that reducing policy restraint too fast or too much could hinder progress on inflation. At the same time, reducing policy restraint.
We have been listening to Fed Chair Jerome Powell speak about the Federal Reserve's decision to cut interest rates by a quarter of a point. Thank goodness we have CBS News business analyst Jill Schlesinger here with me in Studio 57. Jill, I apparently don't speak Jerome Powell. There was a lot of industry jargon, could you say, in some of what he said? Break down the top lines of what he's saying to us.
Luckily for you, I do have a Fed decoder ring. I brushed it off from the Bernanke and Greenspan eras. Okay, so what's really happening here is the Federal Reserve is trying to tell us, hey, the economy is growing more strongly than we thought, even just a few months ago. And as a result, we don't think we are going to have to lower interest rates by as much or as quickly as we thought just a couple of months ago. Okay. So we're going to give you the quarter of a percentage point today. That's fine. But when we look out into the future, their own crystal ball, they see 2 rate cuts next year, 2 rate cuts in the subsequent year. And that's about half of what they thought they were going to have to do. So when the Fed says we're data dependent and they make that kind of remark, what they're really saying is we've got to wait to see what happens in the economy. These are just projections. We could see them change just like they changed from September. So it's important to say this is what they think, and we're not sure if it's definitely going to happen.
I mean, I suppose good news overall for the strength of the economy, but maybe a lot of borrowers are hearing this news and saying that doesn't bode well for me if I have some big ticket items in the next couple of years I want to buy.
I think they're right. And I think it doesn't bode well based on where we are today, because if we really were to consider, hey, what would happen if rates just went down by, say, a half a percentage point next year, it wouldn't really help you if you had a big fat credit card balance, right? You'd say like, oh, great, I'm now paying 23% down from 25. It could go to 21, but that's still so much higher than where we were back before the pandemic. And I think that's the tough thing to swallow. Same thing with a car buyer. Someone goes out and buys a car right now. Rates are higher, prices are higher. And of course, although the Fed does not actually control mortgage interest rates, it's the same story there, but even on steroids. We have mortgage rates that are at around 6.5% right now. With this kind of action in the bond market today, what the Fed is telling us, hey, you're going to go buy a house next year, you're not going to ever see a 5% mortgage. That's not happening.
Man.
It's going to be more like a 6% mortgage, maybe, if you're lucky.
All right.
I'm sorry. Burst your bubble.
Chair Powell specifically brought up the job market. What does that have to do with what they consider and the overall state of the economy?
Okay, so the Fed has what's called a dual mandate. Whip that out at your holiday party. And what that means is they've got two specific jobs. One is we want to make sure the economy grows by enough to create a labor market where anyone who wants a job can get a job. So that's one part of the job. But the other part of the job is we don't want the economy to grow by so much that it would actually contribute to inflation. So when the Fed chair is saying, hey, we think the labor market is solid, he's saying we were wildly overheated. When we had those labor shortages and it was the peak of the pandemic frenzy of I can't find anyone to work here, he's saying we're back off from that. It's solid. We're going to see the unemployment rate drift up to maybe 4.3% from the 4.2, 4.1, but that's not a tragedy. It is kind of a more normal market for the labor market.
So what are the benefits of this quarter rate cut?
Well, I mean, you're going to see a teeny tiny reduction in the way that you are approaching borrowing. So let's say you're a small business owner, you want to get a new loan. You might have a slightly lower rate. Let's say that you're going to go get a car. Maybe it's a slightly lower rate. Let's say that you have a credit card balance. It might be a slightly lower rate. But overall, we know that rates are still a lot higher than they were. I think something that's really important here in you read through the depths of the report that I just want to point out to people. Inside of this report, the Fed said, we think longer term, longer run interest rates, that they're about 3%. Now, why is this important? You don't care what the number is. What we care about is the Fed has told us that's higher than what we thought a year ago. And what that means, our big takeaway should be, interest rates are not going back to 0. They're not going back to 1. They're not going back to 2. The Fed believes that interest rates at around 3%, and remember, right now, we're not at 3, we're in the 4s, that 3% is probably more of the sweet spot. That means if you're a saver, you're happy. You're going to continue to get decent rates. If you are a borrower, you should not expect to see the bargain basement interest rates, that low-cost financing that we saw when there was a complete meltdown in the economy during the pandemic or even before that in the financial crisis.
All right. Good information as always. Jill Schlesinger, thank you so much. Sure.